Barron's Roundtable, sponsored by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Andy Serwer in for Jack Otter. Coming up, the world economy is slowing down as global government debt levels spike. Former World Bank President David Malpass is sounding the alarm on why it's a major concern. Then the buzz around green energy is getting louder, but don't count oil and gas out just yet. Our expert panel will unpack the future of the energy sector and dive into where smart investors should put their money. And later, the bond king doesn't like bonds anymore. We'll look at what he's buying instead. But we begin with our expert panel and three things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Ben Levison, Andrew Barry, and Megan Lenhart. Great to see everyone. A good week. The big news is the Dow cracked 40,000 right at the close. Some real drama there because it was nip and tuck at the very end. So, Ben, last week we asked you why the market was up. It was kind of a paucity of bad news. This year we have approximate cause. This week, I should say.
Yeah, this week we had bad news, but that was good news for the stock market. First, we had inflation. It came in weaker than expected. I guess that's good news, but it's also a sign of a weakening economy. And that was clear from a retail sales number that really came in below expectations. And that was really when you got your good news, or your bad news is good news reaction from the market.
You also had cooling overall, I think. You did see, things like the GDP number for the first quarter. You've seen jobs. This is actually a good sign for Fed officials who are looking for that lower consumer demand coming down and being able to control inflation a little bit better.
Yeah, I mean, it sort of is a Goldilocks situation right now. I know that's a cliche. I know it's a trope. I know it's a saw. But, right now, things are looking so good. I'm looking around to find some bad pockets. I mean, there's stories out there that everything is great. Everything you buy works. Gold works. Crypto works. Stocks work. Savings accounts are yielding great numbers. So, too good for you, Ben?
Well, I think that's the issue, is that the markets really do work on sentiment. And when sentiment gets too much in one direction, you want to start thinking about maybe going the other way. And I think a little bit of that is happening underneath the surface. When you're seeing things like utilities, they had a good week, not the best week, but they're still the best sector this month. They're doing fantastic. And that's a defensive sector. Staples are doing the same thing, another defensive sector. And I think there's a little bit of that defensiveness going on, even though some of that just has to do with falling bond yields.
Another big story this week, Megan, tariffs from the Biden administration. What's up with that?
Yes, so the Biden administration is raising tariffs on $18 billion worth of goods. And this is everything from, your aluminum, steel, which we've talked about before, but also semiconductors, medical supplies. I think the big issue here is actually the 100% tariffs that they announced on electric vehicles and 25% levied against EV batteries and the battery components. This also comes, remember, as we are trying to tamp down that inflation. So it is an interesting juxtaposition. Inflation is usually a component when you sit there and talk about tariffs. It can end up being a tax on consumers.
Well, this just highlights the inconsistency of the Biden administration's policies on green energy. I mean, they want to encourage adoption of electric vehicles, and here they are putting a 100% tariff on Chinese electric vehicles, which could really broaden the market. They've also been blocking on environmental grounds the development of copper and other mining projects, which are critical to the green energy. So it's just been, they've been talking out of both sides of their mouth.
Okay, it's an election year. I think, with these tariffs are certainly playing into some of that. But there's no doubt that the Chinese government is massively subsidizing manufacture of these vehicles. And while there are no Chinese branded cars for sale in the U.S. currently, so, maybe a little bit of a straw man, we have seen this really taking place in Europe. And so I think that there's a little bit of a get ahead of the situation before it becomes a situation scenario happening here. I mean, look, EU is investigating this. India, Brazil, they've hit the Chinese with tariffs. Right. This is something that is going around the world.
Somewhere Elon Musk is smiling, I'm sure. Want to shift gears a little bit, pun intended, and ask you, Andrew, about the great mystery of the week on Wall Street that concerned Warren Buffett. What about that?
Well, exactly. We got news this week about the so-called mystery stock that Berkshire Hathaway has been accumulating the last several quarters. They've requested confidentiality for at the end of last year. So basically, we finally found out what that stock is this week, and it turns out to have been Chubb. Berkshire has accumulated about a 6% stake in the big property casualty insurer. It's worth about $7 billion. It's interesting. Buffett has been selling a lot of stocks in the last year or so. In the last quarter, he was trimming Apple as well as getting out of HP and Paramount, but he loves Chubb. It's a business that he knows very well, and Berkshire's been involved in the P&C business for 50 or 60 years, and Chubb is probably the best run, most profitable, and leader in the P&C business right now.
All right, big question. Will he buy the whole enchilada?
Yeah.
It's all the Chubb.
Yeah, I mean, that's the interesting question. I think he might like to buy it. It's certainly the elephant-sized acquisition that he has been seeking in vain for the last decade or so. Chubb's valued about $100 billion. Berkshire has about $200 billion or so of cash to play with. And I think it would be a good strategic fit for Berkshire. And I think it would also make some financial sense. Question is he interested and is Chubb a willing seller? Both companies wouldn't comment to us, but it's an intriguing possibility. You know, Buffett turns 94 in August, so he doesn't have a lot of time to pull off that big deal.
Yeah. All right. Great stuff, you guys. The global economy is limping along amid rapid government spending and skyrocketing debt. Former World Bank President David Malpass is warning about the risks and what could be done to improve growth. All right, the global economy is facing a slowdown as government debt levels continue to surge. The World Bank projecting global growth to slow for a third year in a row, down to 2.4%. But the United Nations is out with an updated forecast expecting growth of 2.7%. My guest, writing in a Wall Street Journal op-ed that government debt levels are undercutting growth and could cause further slowdown. Former World Bank President David Malpass joins me now. Global government debt, David, may seem abstract to many of us, but spell out the problem and tell us why we should be concerned about it.
There was a period where governments were borrowing heavily, and the U.S., of course, still is, and that props up GDP growth, but it doesn't really create wealth for the long term. It doesn't create business investment, and that's what's missing in the world economy now, and it's especially missing in poorer countries around the world, which gives rise to this fragility that we're seeing around the world.
Yeah, I mean, what is our responsibility, though? What could America do? What should America do about this problem? Is it really something that's on us to fix?
I think it is both for our own good and for the world's good. From our standpoint, we've got this huge flow of capital into the U.S. government, and it's making the decisions for people's lives. And so right now they're making the decision to borrow short term, which puts a huge burden on small businesses. They're having to compete directly with the U.S. Treasury and with the Federal Reserve to borrow in the short term markets. And that means they can't hire workers, they can't reinvest in their businesses. So for our own good, we need to do this. And then I think we have to recognize that one of our markets in the world is going to be foreign economies. And what's happening right now is the U.S. government is crowding out the whole rest of the world in terms of their investment rates. It feels that it allows the top line numbers to look okay, but if you look underneath at affordability, at small businesses, they're really hurting in the U.S. and so they are abroad.
Yeah, let's switch over to the U.S. And we just saw some numbers there about the U.S. federal deficit. You're concerned about that as well, obviously, but people are always concerned about that, David. Is it something that's finally coming home to roost?
Yeah, I think it's much worse now, and you can measure that in terms of the national debt as a percentage of GDP, and so it's gone up. It's really doubled as a percentage of GDP. That since I first started harping on this in 1990, and so what that means is that the government is taking more than its share, and it's doing it both through taxation and through debt. Both of those hurt small businesses. It's a crowding out that's getting more and more intense. It also goes into the regulatory affairs. As the government gets more and more money, what they do is pump it into people that are going to write regulations to regulate businesses to make them give more of their money to the government. And I think we're in a very dangerous spiral right now.
Yeah, I mean, you said change is needed in Washington, but the stock market just hit a new high. You know, inflation is cooling, employment's strong. What's not to like about that?
Be careful on the stock market. Oftentimes people are talking about the S&P 500. If you look at the Russell 2000, it's been severely underperforming, and that shows up also in the small business bankruptcies, the difficulty of starting businesses, and the mid-cap companies' earnings growth has been really severely hit by the rise in interest rates. So the big companies are able to borrow in the bond market, which is favorably biased by the government. The government's really doing everything it can to prop up the S&P 500, but that leaves the rest of the economy strained. That's why we see so much problem with affordability.
Now, quick last question, David. If Donald Trump is reelected, would you anticipate that he would get rid of, say, an independent Federal Reserve?
Absolutely not. There hasn't been any indication of that. There was one story in one newspaper that was unsourced that said that. But the independence of the Fed is helpful because it allows the defense of the dollar, and that allows the U.S. to grow faster than everyone else. We're in a giant global competition, and so having the Fed do a good job is really important. Now, recognize they were way behind the curve on raising interest rates. They stayed at zero too long. And so that's part of what we're paying for now, but we're also paying for government spending and for regulation.
All right. Thank you very much for joining us, David Malpass. Good to see you.
Thank you.
The green push is gaining steam, but the oil industry isn't done just yet. Where to invest in the energy sector next? The shift to green energy is in full swing, but oil and gas still has a role to play. Barron's has assembled a panel of top energy investment experts to break down the industry and look at ways to invest in both traditional fossil fuels and renewable alternatives. It's the Barron's cover story this week. And so, you guys, it's interesting. Oil, renewables, you know, where do they fit in together? Should you invest in one, the other, both? Ben, let's start with you. What's the big picture for the oil business these days?
Well, right now, things are doing pretty decently. I mean, you look at oil prices, they're just under $80 a barrel, and they're probably going to stay around there with the floor maybe at 75, just because you don't have a ton of production. U.S. is at record levels, but it's not going to be going much higher. You have Russia, which is surprisingly pulling back on production, and Saudi Arabia has been very good about keeping OPEC in line with not overproducing. And as long as that's going on, you're going into a time when demand is going to be higher. It's summertime. People are driving in the U.S. And there's one of our participants actually thought there's a 25% chance that oil prices could go to $100. So right now, it's looking pretty decent.
Yeah, but what about all the geopolitics and wars out there?
Well, you know, I didn't mention that. And it's because it's not having much of an influence right now. It's partially because this is not the 1970s. The U.S. is pretty much energy self-sufficient at this point. And all of Russia's oil, which is not coming here, is going to Asia. And it doesn't really need to go through these channels that it did before. And in regards to Iran, it needs to be able to export its oil too. So it's not going to do anything to jeopardize that. And so for now, geopolitics really is not priced into oil at all, the panelists say, and let's hope it stays that way.
Andrew, what about stocks? I mean, how do you play oil and gas?
Well, I mean, the energy stocks have actually been doing pretty well this year. The XLE, which is the leading ETF, is up about 15%, which is actually topping the market. Many of the oil stocks are at or near new highs, so there are no real bargains to be had. But if you want to invest in energy, I mean, I would consider the super majors, which are Exxon, Chevron, Shell, and BP over in Europe. I mean, Exxon, which is the industry leader, just got a overweight rating a new rating from the Morgan Stanley analyst week, Devin McDermott. He sees the stock going to about 145 from around 120 where it is right now. He sees rising cash flow and free and earnings in the coming years. Chevron's been somewhat out of favor recently, partly because this Hess deal of theirs that they're trying to do has gotten hung up. But it's trading with about a 4% dividend yield and a pretty reasonable valuation. The European majors are super cheap right now. Shell and BP around 8 times earnings, 4% dividend yields, while the U.S. majors trade a good deal higher. Part of that has to do with the fact that they're under a lot of pressure in Europe from environmental activists, and a lot of European investors don't want to own it. But there could be some catalysts ahead for them. You could see a potential merger of the two companies, redomiciling, and some other positive developments for those companies right now.
Yeah, is there an AI play here even?
Yeah, I mean, you're seeing, AI is, I think, maybe helping the gas stocks right now because gas is used a lot for electricity production, and you're seeing basically increased demand for electricity, at least the hope for it. Plus, you've got LNG supply, which will be ramping up in this country. So you're seeing stocks like EQT and Chesapeake, which are big gas producers, have been doing better. The natural gas market, which had been weak, is actually showing signs of life. And you're seeing in the utility sector, the independent power producers like Constellation, which has the biggest fleet of nuclear power plants in the country, have been on fire because basically companies are looking to basically get scarce power.
Right. Megan, renewables. They used to be a thing. Now not so much. What's going on there? Are there still places to play there?
I'm going to push back and say renewables are not a thing. I mean, energy demand growth, is certainly up 2%, and AI has something to do with that for sure in those data centers. There's actually been a significant shift in the U.S. power generation away from coal and to renewables. And this is not just a young person talking about green energy here. I mean, this shift is actually, in the process of potentially tripling solar power in the U.S. by 2030, and that isn't priced into most stocks at the moment.
Yeah, well, let's talk about stocks and investments in this sector.
So this sector is volatile, and you really do have to be careful and play with a little bit of nuance here. But our panelists are actually pretty bullish on that solar installer that we keep hearing about and developer Sunrun. Lucas White actually did mention, he's a portfolio over at GMO, that he really likes solar manufacturer for solar. He likes Solar Edge, and of course in that biofuel space that we were just talking about, Darling Ingredients and Nest are actually some of those companies that he thinks are actually pretty high quality with some competitive edges there. Now, of course, you don't just want to pick one player here. As I said, pretty volatile. So you do need to pick a basket of stocks. I mean, an iShares Global Clean Energy ETF might be the way to go.
Yeah, absolutely. Probably need some diversity, although you might be diversifying. That's what always happens with me when I look to do these things. All right, thanks, guys. Ben and Megan have a pair of investment ideas, plus the bond king doesn't like bonds anymore. We'll look at what he's buying instead. Stay right here. All right, now is the part of the show where we talk about investment ideas, action items, things to do the weekend. Andrew, I want to start with you and ask you a little bit about the bond market. Some tough times for fixed income investors.
Well, bonds have sat out the party in most asset classes this year. Most bonds are showing flat to negative returns. And I might highlight now treasuries, keep it simple. Treasuries around 4.5% yields. Also mortgage securities, which don't get a lot of credit, are yielding 5.5%, 6% right now. And speaking of bond kings, you have someone like Jeff Gundlach's Double Line Total Return Fund, which is actually a pretty good play on the mortgage market.
Yeah, speaking of the bond king, he's the ersatz bond king, the real bond king. Bill Gross, I was out in California, you guys talking to him, and of course he's the one who built PIMCO up to the giant that it is. He's 80 years old, retired now, and running his own money. There he is. There's Bill Gross. Hey, Bill. And but he doesn't like bonds. And it's a bond bear market, so he's looking for yield equivalents. He likes MLPs, Master Limited Partners, oil and gas, and also some utilities. We talked about AI plays. There's some AI going on there with Con Edison and Dominion. So it's interesting to see a guy like that backing out of bonds. Megan, I want to go over to you and ask you about your pick. You got something going on with a sleeping European food giant? What?
So I'm actually stealing Andrew's pick. I will give him full credit, but he is looking at Nestle, and I am as well. I think it's an interesting company right now. I mean, yes, it is a sleeping giant, as he calls it, but this consumer goods behemoth includes brands like Nespresso, Pellegrino, Gerber, and, it's been a disappointment in recent years, but a secure 3% dividend, hey, can't be too bad, right?
Oh, wait a minute. This is another yield equivalent? You also get that there.
Right.
Some upside as well. I love all
Definitely.
those. You know, food, I'm getting hungry. Ben, do we have more food? More food to talk about?
We have more food. I'm looking at Hormel, the maker of Spam, everybody's favorite. Hormel has been a terrible stock, but it jumped 15% after reporting earnings at the end of February because it's finally doing the things that investors have wanted, that they think could turn around. It's held onto those gains since then. Earnings are coming up at the end of the month, and it's looking really interesting right here. Take a look at it before that report.
I want some more brands out of them. Come on. Dinty Moore.
Applegate. You know, that's the healthy stuff.
Right.
Oh, really? I didn't know that. I know Black Label Bacon. Skippy Peanut Butter, too,
Skippy
right?
peanut butter, yep.
Also, your Planters nuts, guys.
Okay, well, that is a really great, that's a great place to end right there. Some nuts. All right, Ben, Andrew, Megan, great ideas. Thank you very much. To read more, check out this week's edition at barrons.com. That's all for us. See you next week on Barron's The Roundtable.